Oh, that was fun. I can assure you, trading. Everyone says trading is stressful. What we find stressful is when our internet and connections die. You're not going to believe we have actually four networks, two mobile and so three mobile and a fixed line. And the one I'm on is a very powerful one because we live in quite a remote part of the world. But hey ho, right. Um, just before we pick up on what David was saying, I just want to have a quick look at what is happening on the calendar. As we can see, there's not huge amounts of important fundamental news. Clearly, the one that's dominating the airways at the moment is what is happening over here in the UK with Brexit. All I would say about this, and there's so much being written about it and being written as we speak, a lot of it is, it's one of these classic cases where it's, you know, buy the rumor and sell the news. And but there's one thing that is really incontrovertible, unless something really dramatic happens, which I can't see it's happening. On the 29th of March, that's it. The UK leaves. How it leaves is what all this kerfuffle is about, is whether there's going to be a deal, a no deal. Maybe there's an extension to, the agreement, as it were, but it is enshrined in law. And sometimes I think the commentators that are writing actually forget that. So the 29th is, they say it's a cliff edge or what have you. What you're seeing on your charts with regard to the British pound, a lot of it is a reaction to, as I said, rumour, speculation, whoever, the latest person who pops up and, and makes some and comment. And obviously what is happening in Parliament. The scenes that are in Parliament are probably no worse, or there's certainly no worse than those of you who follow Italian politics. You would have seen all sorts of punch-ups and bad language and bad behaviour and toys being thrown out of prams by Italian politicians. And I should know I am Italian, so it's not what people expect, if you like, of the Brits, if you like, or the stiff upper lip and what have you. But they all seem to have, they're in this bubble, and they've all got to say something and do something. But from a legal point of view, the 29th is it. Now, in the run up to the 29th, there is going to be some tremendous trading opportunities, and you really have to see it as a trading opportunity. As David said, if we expand, I've actually got the 10-minute CSI here, and we can see here, even on the 10-minute, the yellow line, there's pound buying. Okay, we've got a little bit of buying now coming into the US dollar, but everything is relentlessly, pointing in the same direction. So, if you're looking for a trade, sometimes it is the pound that you are going to have to consider. Now, with volatility comes heightened risk, but trading volatility, it shouldn't put you off as long as you understand what is likely to happen when volatility hits the market for whatever reason, fundamental news, political news, statements, etc. Because it's going to be, you're going to see it on the chart, and which is the prime reason why we developed this indicator here, which is the volatility indicator. This is fired off in real time. There's actually three measures. The way volatility is, traders approach it. You either use something like Bollinger Bands. I don't have Bollinger Bands on my charts. I know we've got traders who have our tools, but like to use Bollinger Bands. They're based on standard deviation. So whenever anything is out of the norm because of volatility, the bands obviously explode and the price goes up, or it's based on ATR. Our indicator is based on ATR, average true range. It means when it's triggered, it means the price has gone out of its average true range for this particular time frame. The other measure of volatility that people like to use is the VIX. Now you might think, well, why the VIX? Because when the VIX is rising very strongly, fear has entered the market. When markets are fearful, it's inevitable that you're going to get volatility. Traders panic, investors panic, everyone's going, oh, the world is coming to an end. That is the perfect time for you to find a trading opportunity. And you're going to find it if you understand the relationships between the currency pairs and the other markets. So when the VIX suddenly explodes, what is the currency that is going to move fast? Well, the dollar is probably going to move, but the one to consider is the yen. When the yen is being bought aggressively in the market, it means the market is very, very fearful. So what are you going to be doing? You are going to be buying the yen against one of the pairs. The pound yen is probably the most volatile of the yen pairs because there are a lot of algos who trade this particular pair. But there are other yen pairs that you can consider as well. So the other thing about volatility, as David said, it's really just a compression of time. Things happen really, really quickly. What you also get with volatility is you get momentum and you get an exaggeration in the price moves. But what happens is when the volatility then starts to die down, most times, I can't give you a definitive number, but let's say would you say 80%, David? 80% of the time, the reaction you get is exactly that you see on this candle here. You will see a retracement to within the spread of this candle. That means that if you are taken this move lower in this downtrend, when you see this happening, the choice you can make, and you can almost say, that's it, I'm not going to chance it. I know most times price will retreat with it, I'm out, and that's it. You can then consider going back into this move because once the volatility comes down, the initial trend, if you like, carries on in the same direction. You would have to wait until the low is taken. In this case, it's a down candle. The low is taken out. But you also know that there is likely to be retrace into this candle because at the same time you have a wick to the bottom of that candle. So not only do you have volatility, you then look at the volume under that candle. If that were all selling, that would have to close down here and probably much lower. So there's obviously some kind of price support coming in here. What you also have to remember that volatility is always used as the perfect opportunity to trap traders on the wrong side of the market. So traders, we sit there watching our charts and they're sort of chuntering along quite quiet, minding their own business, and suddenly you have this volatility come in, and the natural reaction is to jump in because you are fearful of missing out. FOMO is the biggest fear that we have to try and manage. It's fear of missing out, and this is where traders get trapped. Now, inevitably what happens is they were probably right in the sense that it did carry on lower, but by the time their stops are taken out, or the stops are taken out, they've lost money. It takes a lot of guts to be able to say, okay, I'm actually going in. But if you hold off and wait and see how this volatility plays out, you can take a more considered, if you like, view of taking a possible position. And in fact here it did go, then it carried on lower. This is the candle that is of interest because it's stopping volume, it's a hammer candle, and yes, it did sort of drift along. And in fact, if you combine it with the CSI, I've written about it on my forex trading page at Facebook, and it did drift higher, but it didn't really sort of manage to get much, as I said, until you get this little shooting star. It drifts lower again, and then we've now seen more congestion after a hammer candle. This is very typical price action. Also, after a shooting star, you will get a period of congestion, and you really have to be patient if you think this is going to go high. And in fact, it has carried on higher, as we've seen reflected on the CSI. Now, the other thing about volatility, if you don't see it triggered in the faster timeframes, in a time frame that you are looking to take the trade, which is the importance of multiple timeframes. If we look at the 10-minute, well, I haven't checked the 10-minute here, is just see if you've got more than one time frame, just see if you've got volatility on a slower time frame, because sometimes you don't see it on the faster one, but you can see it on a slower one. That is even more of a stronger clue that the move that you are seeing in the faster time frame is going to come to a pretty strong stop, a stop, which is why it's so important. You have to use multiple time frames. So if you see it, let's go back to the 5-minute chart here for a second. So if you see it on a 5-minute chart, but you don't see it reflected on the slower time frame, fine, that's okay. The chances are it's going to retrace, possibly then go back into the same direction. If you see the volatility triggered on the slower time frames, it's almost guaranteed that that's it. The price is going to stop, it's going to retreat, and it's almost your exit signal. Then you have to wait until the trend, the direction, you get some firm view of where the where the price is going to go later. And what I'm also going to look at today is we're going to look at primary and secondary trends. This is something we cover in great detail in the Forex program, and there's a really, really nice example of this. Again, it is on the pound yen, and it really, if you look at if we take, say, the primary trend as sort of starting way over here when we had the yen flash crash, and we've had this this nice run up, then we had this sort of pullback correction moving into a congestion. Then we had the primary trend continue, as it were. And those of you who've come along have heard me talk about these two candles here, which were actually some great signals that we could expect a correction. And in fact, the question is it going to be a tradable correction? And in fact, this is a daily chart. It has been I'm gone. I've gone. Can you hear me? Can you hear me? Oh, right. So something's wrong with my it has been a tradable correction. But in fact, this pullback, this correction here, in fact, we've got a bullish engulfing on the day here. Forget Brexit for the time being. Let's just look at primary and secondary trends. This was actually, just a secondary trend, and it looks as though maybe the primary, which kind of goes all the way back here, but if you want to base it from here, from the pull away from the volume point of control, maybe is back in contention, and it really it's a question of whether it can take out the highs of this candle here, when in fact the secondary sort of kicked in, as it were. So talking about primary and secondary, this is the daily chart, but you see this on all time frames, and it is particularly pertinent if you are trading the faster time frames, because it will help you establish whether a move that you are in is actually coming to a genuine reversal, or it is simply a pullback. And the only way you can do that is by looking at the volume underneath those candles in the secondary phase of price action. Sometimes we even get tertiary trends as well, but let's just look at primary and secondary. And of course, primary and secondary trends really the whole concept, if you like, has come out of Richard Wyckoff, which again we cover in huge detail in the Forex program. Are you ready to take over, David? Are you okay? Okay, fine. I'll just pass back to David. You don't need to see my charts, you've got yours, yeah?
Yeah, there's a question about congestion lines.
Yeah, sure.
Thanks, darling. Just swapping screens again. Hopefully you can see mine.
Yeah.
Good-o. And as you can see, we've now, I've gone over to really look at the commodity currencies, because now we're starting to see buying of the dollar, we've got buying of the yen, buying of the Swiss franc. So we're starting to break away from that position of 10, 15 minutes ago where everything was selling off. Now you're spoilt for choice. And really just to highlight that, let's go over to the multiple time frames. We've got some decent buying on the dollar. And what's interesting, as always, when we go through, the nice thing with Ninja is that, I've got the dollar CAD here. The nice thing with Ninja is that it actually prints the local time for us. So it's very easy to highlight where you are precisely and to scroll back and look, okay, well, that was London. This was Europe, whatever. This is 1 o'clock our time. US markets will be getting underway in about 10 minutes or so. Because they've moved before we have moved to British summertime. But what we're starting to see now is the trend develop, certainly in terms of buying of the dollar. But what's more interesting is that This is something you see all the time. As we get to the session crossovers, expect to see reversals, expect to see changes in sentiment. What has gone on in the London session, if it's selling of a particular currency, particularly one of the main currencies, you look out for the opportunity for a reversal and a complete reverse in sentiment. So if you've seen dollar buying in the London session, you might well be looking out for dollar selling in the US session, or vice versa. It happens relentlessly. The same is true coming out of the Far East into the European and into the London session. If you've seen maybe the euro selling off or the pound selling off, you go into London and the reverse takes hold and you see a reversal and an opportunity to trade that reversal. And this is what you see all the time. And it's purely down to the centers opening up, and it's almost I wouldn't say it's a bloody minded approach, but it strikes you as that sometimes, that it's just a case of, well, you were doing that, so we're going to do this. It's almost like that. It feels like that at sometimes. But of course, it's all allied to volume as well. Now, the other thing also, which particularly is relevant to the commodity currencies, they will tend to move in similar directions at much the same time, not always. So if I change this over to the Aussie dollar, for example, and the nice thing about looking at it across the spectrum of the Aussie dollar, you've got the Aussie dollar here, we'll put the New Zealand dollar up. I think the strength of trend in the New Zealand dollar is maybe a little stronger. There we go to the downside, so we've got a decent move to the downside. The nice thing with it is that when you're looking at it, those three currency pairs together, for example, New Zealand dollar, Aussie dollar, and dollar CAD, what you have is you have an inverse one to give you an inverse view of the price action and also the volume related analysis. It's a little bit like looking at, if you're trading euro dollar, having the dollar Swiss up, because that gives you a mirror image, an inverted image of what is going on your pair. The same is true when you've got strong moves in the commodity currencies. As I say, generally they move together. They don't always, though. They do separate, obviously, for locally driven factors, but generally speaking, you'll find that quite often they will move together, particularly against a major like the dollar. And when they do, it's also a nice way of, if you're trading, for example, you've decided you're going to short the New Zealand dollar, it's always nice to keep an eye on what is going on in terms of the Aussie dollar, but also the dollar CAD, because the dollar CAD will then give you that inverse look at what is going on, because the dollar is primary in terms of the dollar CAD, and obviously it's the secondary currency in terms of New Zealand and the Aussie. So it's just a really nice way of, it's not relational aspects so much as really just related charts that can help to give you those little nuanced views. If you see maybe something happening in one pair, maybe in the Aussie dollar, you're in the New Zealand dollar, maybe you're seeing, I don't know, some volatility in the Aussie dollar, maybe you're seeing some dying away of buying pressure or some increasing in selling pressure, and perhaps you're not seeing it in the New Zealand dollar or the pair you're trading. It's quite possible that it's happening first in the Aussie dollar and then we'll maybe flip through to the New Zealand dollar and to the CAD. You've got to look at all these things, and it's an advanced way, if you like, of trading a currency pair and just understanding where to look for assistance in guiding you as to what you're doing, what the indicators are doing, what the indicators are telling you, what volume price analysis is telling you, and so on and so forth. Let's just pop up the 3 minute just to, I don't know, did you answer Lisa's question on the level? I can do it here. Yeah. Let me just very briefly run through the levels here. That's all right. The yeah. Okay. Fine. I'll just run through it very quickly. The yellow dashed line here is the fulcrum of the market. This is the greatest level of volume on the volume point of control, which is over here. So that is the point at which price agreement has been reached. And then as either a bearish or bullish sentiment takes hold, starts to prevail, then the market will move away from that. So that is the fulcrum. And then on the volume point of control itself, you've got these high volume and low volume nodes. In terms of support and resistance, Right. Let me just explain the difference between these various lines. The yellow line comes off the volume point of control and is associated with the price histogram up here. So this is the high volume and low volume nodes. So that is volume, price, and time, which is the volume point of control and the VPOC indicator. These levels here, these yellow, these red and blue lines, are from the accumulation and distribution indicator, which works purely on price. In other words, they are traditional support and resistance levels, which I'm sure we all understand in terms of support and resistance based on price. So when a level is hit repeatedly, either from above or below, that's what builds these levels, these support levels, these resistance levels, which then act as either support or resistance going forward, either as a platform of support or as a ceiling of resistance. In terms of their thickness, that just denotes the fact that that is a deep area. So we've got some deep price congestion or some deep price resistance or support here. It's less developed here, less developed here. We've got another area here which is being tested. This is a ceiling at the moment which is being tested. You can see it here. The market is trying to rally through there, but it's being held on, or it's being pushed down by this line here, which is a line which has been tested before, is relatively strong, but is certainly not as strong as this level here. So to get through here is not going to take as much effort here, but the primary difference is that the yellow dashed line is off the volume point of control, and all these other levels here, these red and blue levels, are based on price, support, and resistance. Hopefully that clarifies that one. Let's just pop the 3-minute down for a minute. Let's just see where we're going. In terms of the 30-minute, we had the rally, we had this price weakness appearing on the 30-minute time frame. So from a 30-minute time perspective, you would certainly have been looking at that as an opportunity to short. That's certainly not a sign of strength. It's a sign of weakness. There's a very minor level here of price resistance which was hit. We had a pivot to the upside, which suggests the market's finding some weakness here, which is what we're seeing. But then we're not seeing this market fall out of bed. But then on the other hand, in terms of a 30-minute time frame, it's been bearish with the trend monitor holding you in throughout this particular phase of price action. And the probability right now is all we're seeing is just a minor reversal in going back to what Anna was saying about primary and secondary trends. This is your primary trend lower. All that's happening in here is a secondary trend higher before the bearish trend is re-established once again and we go lower in the move. And that's something, as Anna said, we cover in great detail in the education program. Let's just see what's happening on the dollar CAD, which will be the inverse. And this is what I said. When you're looking at trading these markets, what this gives you is it gives you an inverse perspective. For example, on the 3-minute, we see this price action coming in here. We've got a very deep wick to the upper body. We've got very good volume under there. We can compare this volume right the way across this because we've got the US session open now, but we've been running through the UK session, so we can compare volumes. We've got a lot of volume coming in. Market's weak. It tries to rally. It falls back near the open. The market carries on. Then we get a bearish engulfing candle at the top. Now we're starting to see the rollover. Now, if you see that signal, for example, on a dollar CAD and you're trading the Aussie dollar or New Zealand dollar, it's just giving you another perspective, if you will, on the dollar. Yes, it's against the Canadian, and obviously you would be looking at it in the context of the currency indices themselves as well. But it just gives you that different perspective and gets you away from constantly focusing on one chart all the time. So it's just a nice example there. And you're also seeing that on 5. Got the same thing here. We've got a lot of volume coming in. This doesn't look terribly strong. Market's trying to rally, falls back, exhausted, lots of volume going in. It doesn't look terribly great. And what's interesting here is we had decent volume under this candle, narrow spread, higher volume under this one. Looks a little bit odd. Now we're starting to see the rollover. We've got a pivot high to the top of that particular candle configuration. So we should be expecting to see the market just roll over. And given that we've got the volume point of control here, the yellow dashed line down at one spot 33, 32, then the probability is that that's where we're heading in the short term. We've got some minor potential support here, this red dashed line. Remember, this is price based. So this was, you can see it here, was tested, finally got through on that candle, but it was tested several times. So it's a decent area. It's not that strong. It's certainly not as strong as this one down here, or indeed this one above it. But we've got a little level there which might, hold things up. So for that to go through there, we want to see some decent volume pushing that market lower. If we go up onto 10-minute, let's see what the 10-minute chart is telling us. Again, it's a very similar picture, and once you start to see a market that's trying to rally, but you're seeing these wicks to the top of the body all the time, another wick, and then you get another one here which really stands on the top, and all with pretty good sustained volume. That is telling you that it's not necessarily telling you that market is just going to roll over and you get a full-blown reversal from primary trend higher to primary trend lower. But what it is telling you loud and clear is that this market is weak. So don't be surprised to see this market reverse. Now, you as a trader might decide that you're happy to stay in that position because the trend monitor is still blue down the bottom here, so it's still bullish longer term, in inverted commas, given we're trading on a 10-minute time frame. But it also is telling you that if you want to stay in, then you've got to figure out whether this is actually a reversal in the trend from primary to primary, or is just a secondary pullback. But it's giving you all that information. You then have to decide what you want to do. Do you want to stay in there? Do you want to come out? We go down onto the 30, for example. What are we seeing here? Same sort of thing. We're seeing weakness come in. We've got a nice wick to the upper body, nice shooting star type candle. We've had the rally higher, and the market is looking a little bit fragile. That's not to say it's going to roll over and give us a nice trend to the downside. It's just looking weak for the time being. We then have to analyze what is coming in. You'd be up onto the faster time frames, try and figure out whether this is indeed a change in sentiment. And you can see down here on the trend monitor, that is starting to be reflected in terms of the trend monitor. We've seen the transition from bullish blue into the darker blue. It's just confirming the fact that we are seeing a pause. We're starting to see a shift in sentiment. The market is starting to reverse. But bear in mind, we've got the volume point of control here. So if you were looking at this as and I use the words again in inverted commas, a longer term position, then you've got to decide whether where we are here and where the volume point of control is in terms of the depth of volume that's sitting in that region, is that enough for you to take a trade? And to be perfectly honest, given it's only 6 or 7 pips rather, the probability is not, because the probability is that at the very least, if this pair gets back to this region, it's going to congest. It's not going to go through the volume point of control with speed, purely because there's just a huge concentration of volume around here. So that volume is going to cause the market to pause. It has to. It's the same as price-based support and resistance, but we just look at it through the prism of volume. So if you have big concentrations of volume, the probability is that the market is going to pause there at the very least. So if you're trading this to short side and you were jumping in now, the probability is it's not going to deliver what you need, particularly on a currency pair that has a big spread. For example, if you're dealing with 5 or 6 pips on the spread, it's kind of okay if you're dealing with a euro dollar, for example, but if you're dealing with anything other than that, where you've got 3, 4 or 5 pips, it's just not going to deliver, because by the time you've got down here, you might just about be sneaking into profit, but the probability is this market's going to pause here. So you've got to factor that in as well. You can see as I'm talking, we've just transitioned through to a darker red. So we are definitely seeing a shift in sentiment going on here on the dollar CAD. Up onto the 5-minute, just shift that across, make sure I click the right, there we go. Click the right one, there we are. And what the 5-minute is telling you is that on the 5-minute time frame, we are now at the volume point of control on the 5-minute time horizon. So if you're trading the 3-minute, don't be surprised to see the market congest and pause, because it's now hit the 5-minute VPOC. And this is all part and parcel of multi-time frame trading. Equally, the trend monitor down here hasn't transitioned yet because it hasn't had sufficient time. It has on 3. That's giving you a heads up to the 5-minute trading position that's what's going on in the faster time frame. Everything comes up at you from the fastest time frame through to the slowest. So if you've got a 1 minute that's doing something, that's going to ripple through to the 2, 3, 4, 5, etc., etc. Let's flick that down onto the 30. Well, the 30 is really just, as I say, that's just really reflecting the fact that we've seen that weakness coming on quite a slow time frame. So we're expecting something to happen. We're expecting a pause point. We head back to the CSI, see what's going on there. Where are we? Here we go. Let's go to, that's on 5. Let's go to 15. Well, we're seeing the dollar selling off here. As you can see, never really got anywhere near possibly overbought condition. Starting to sell off quite strongly, as indeed the yen's rolled over as well. And we're starting to see the turn up in all the commodity currencies. So we're seeing New Zealand, the CAD, and the Aussie all kind of turning up together and offering potential opportunities as the dollar is sold off. Head over to the indices just to confirm that. Let's just go to the 3 of them here. There's the dollar in the middle. Okay, we had some bullish sentiment on the dollar. It's looking a little bit weak, and it's just starting to sell off now. Not that strongly, but it's starting to sell off. Over on the yen, similar sort of thing on the yen, flatlining into congestion, little bit of selling off coming in there. What's the euro doing? Euro's selling off reasonably, but congestion phase, we're now starting to see euro selling, so the euro might be one to look at as well as that develops. This is all on 15. So this is slower than the time frames we've been looking at in terms of the charts themselves. Just head back over, see what's going on. There we go. Let's see that's on the dollar CAD. Let's just see what's happening on the New Zealand dollar. And we're starting to see that selling of the New Zealand dollar, but now we've got a situation on the New Zealand dollar where we've climbed back up to the volume point of control. So again, if you're looking to jump into that trade, what are you expecting to happen now? Well, pretty much expecting what's happened here, which is a doji candle. It's congestion. We've run up into this volume. This is the highest volume on the volume point of control itself. What's interesting, and it really does demonstrate this very clearly, is one of the huge advantages of the volume point of control indicator is that it highlights these low volume nodes for you. You've got low volume up here. We had relatively low volume here. And what will happen at these points is that the market will tend to go through these pretty swiftly because there is nothing in the way in terms of from a volume perspective to cause that market to stop. It's also not an area that's ever been important in the past, therefore why should it be important now? There's a slightly more subtle variation of the same theme, but in essence, when the market gets to these low volume areas, you expect it to move through pretty swiftly because there's nothing there to cause it to pause. So why should it? What's interesting here is we had some pretty strong resistance, which was acting as resistance there. We've gone through that. Decent volume. We've got rising volume here. So that was pretty okay. Now we're back up to the volume point of control. Now, if we're going to get away from this region, first of all, we'd like to see some congestion building. And then thereafter, if we are going to carry on higher, we want to see some decent volume because we've got another level of price resistance overhead here. We've got quite a wedge of volume above. But if we manage to get through this region, then you've got a pretty clear run through because you've got very light price resistance. You've got this and this, which is negligible. And then you've got this low volume node up here. So if we can struggle up through here in due course, then that is the point at which you might be looking to take a trading opportunity, because once you've broken away from the volume point of control, once you've got through this dense area here, once you get up into these lighter regions, then you're home and away. And that should be the point at which the market will rally quite strongly and get a decent trend out of it. It's all about identifying the opportunity from a chart perspective. It's not about risk and reward. It's about looking at the chart, identifying the chart. Does this chart offer me a decent return on my risk? If it does, fantastic. If it doesn't, go and find something else. Let's just flip. Yep, just flip this over to the Aussie dollar. See if we've got a pretty similar situation, as I said, on the Aussie dollar. What's interesting about the Aussie dollar is really reflecting some weakness now. We've had two candles here. Volume under here was good. Hit the VPOC, bounced off. Weakness coming into it. Even reinforced further with the next one. Higher volume. Bash, in it goes. Closes back near the open, looking pretty weak. Lots of resistance over. We had some pretty strong stuff here, pretty strong here. And of course, we're trading in this wedge of volume here as well. So this doesn't look terribly strong, certainly from an Aussie dollar perspective at any rate, which may help you trading the New Zealand dollar. I'm just going to switch off for a moment because I think there's a couple of questions. Bear with me a moment. Catching up the questions. Apologies. When I'm in full flow, I tend to have the chat box closed. So apologies. I don't actually see the questions coming in as they come in. Simon, if the price was trading in a range and this reversal was at the top of that range, does that give you confidence to take that trade? Yeah, it absolutely. It's putting all these elements together, and it's actually quite hard to describe in webinars because obviously we are limited in terms of the number of screens and the things that we would look at. But what we try to convey is that you put together all the elements, you put together the elements of the chart, you put together what it's telling you, you overlay that with the indicators and of course the volume price analysis, and hopefully that will give you all the pieces of the puzzle. What I've been talking about here is really looking at the commodity currencies and looking at them as a little group, if you will, and trading whichever one you may be trading accordingly, because they give you information. So why not use it? But to use that information, you do need a certain number of screens. So it's quite hard to convey it, but hopefully you understand the principles. But yes, if that was at the top of the range, why not? Obviously what you can never be certain of is that a top of a range, or is it just simply a point at which the market is reversing from a primary to the secondary? One of the most powerful applications of volume price analysis, which is why we bang on about it so much, is that the hardest thing to do in trading is actually staying in a trade. And the point at which you are shaken out of that position is when the market pauses and reverses. Whether that's down or up doesn't matter, because you've maybe got into a position, let's say you've taken a reversal trade, you've got in early and you're happy, and let's say it's a short position, and then the market starts to rally against you, and that's when the emotion kicks in, that's when the fear kicks in, and the biggest fear is the fear of losing something you had, because you've got profit in the bank, which you've already banked, you've mentally banked it and thought, I'm fantastic, I'm 30 pips up, and then you start to see that drain away, and your emotion starts to take hold, and before you know what you're doing, you've closed out because you're frightened. It's perfectly natural. You don't want to lose something that you banked, and you just don't want the market taking it back from you. Where volume price analysis then steps in is to help you understand whether that is indeed a full-blown reversal or whether it is simply a short-term reversal, and in due course the primary trend will be re-established. And that is one of the huge powers of volume price analysis, because it's the simple mathematics of trading. If you cannot stay in a trend to maximize profit, then all you're going to be doing is making a load of small losses and some small profits. And basically your trading profile will stay flat. It might fall slightly because you've got commissions and other things to factor in, but ultimately it won't move forward very quickly. And that's the basis of trading. You have to sit in these trades and maximize what you can. And therefore it's using all the tools, all the analysis, all the indicators you can to try to help to give you that answer as to what is happening here. Is this a reversal from a primary trend lower to a primary trend higher, or vice versa? Or am I simply witnessing a pause point in the major trend? And that is the power of VPA, and that's one of the huge things that we spend a long time in the program talking about. We also talk about it here from time to time as well. So hopefully that answers that one for you. Thanks, Lisa. I'm glad the book is helping you in these sessions as well. I think I'm okay on the questions. Fantastic. Yes, Bentley is our preferred mark, but we wouldn't say no to Rolls-Royce, but Bentley's preferred. Yeah, let me just switch back to Anna because you've been listening to me droning on for long enough. Hold tight a moment.
Hopefully you can all see my screen now. You can listen to me droning on a bit as well. Just to go back to what Simon was saying about the ranges and on the slower time frames, one of the things I mentioned in our forex webinar for the London session a couple of days ago, and I still haven't got around to doing it, but I am going to, and that is when the lines on the CSI are moving in the same direction, and that is telling you that is pretty much that pair is in some kind of range trading, congestion, a phase of price action. So if you look at maybe a slower time frame, I don't know what your preferred combination of time frames is, but just say you like to take the trade on maybe on a 5-minute chart, and you kind of benchmark yourself against, I don't know, maybe an hourly or a 30-minute. And there's no hard and fast rule about this. You have to sort of try and see what works for you, but also what works for the pair that you are looking to trade, because we haven't mentioned this for a little while now, but the volatility of the pairs that you are looking at will vary. They don't just vary because of the pairs themselves. They may not be a very wide-ranging pair. They may trade in a very narrow range. That is their characteristics, but they also trade they have a different volatility profile according to the session that you are considering. Very broadly, you will find the Canadian dollar will come much more to the fore during this session because the Northern American traders join the forex market. There is a link which I haven't got up at the moment, but if you type in something volatility pairs investing.com, they will actually tell you not only the range, the days that they're likely to be moving more, but also the session. So it's a really, really nice resource to go. But to get back to the CSI, so if whatever combination that you like to use in terms of your multiple time analysis. So if we have here, this is the 5-minute, because what we're looking for divergence. We're looking for divergence as potential entries. We're looking for divergence that tells us that there is a strong move one way or another, and then we're looking for divergence to tell us that that move is coming to an end. Now, that is just based on the price. What we also have to factor in with these pairs is the drivers for any moves and any divergence. With the pound yen at the moment, or certainly anything with the yen, as I said earlier, it's going to be influenced by general market sentiment. So if you have a pair such as the pound yen, where the pound is moving strongly because of Brexit, but the yen is also, so for example, if the pound is being strongly, as we saw here, this point here on the 5-minute chart, it was moving very strongly higher. The yen was moving strongly lower, but it was also moving strongly lower because market sentiment, the indices were, feeling happy and traders were cheerful. You have got almost like the perfect scenario. You've got, strong moves. It's not an asymmetric move. You are going to get some, a great move, and you're probably going to get some momentum as well. Going up to the slower time frames and getting back to this question about ranges, let's go up to the 30-minute chart, for example, and see here. Well, what is moving just around it in the same direction? Well, if you look at something like the New Zealand and the Aussie, the Aussie New Zealand, they're both moving in the same direction. What else is moving in the same direction? Well, let's just these two for now. Well, they may be moving in the same direction as I said on the 30. It could even go up to the 60. Sometimes it's even on the day. Does that mean there's no trading opportunities? There's no divergence down in the faster timeframes? No. And in some ways, knowing that they are in this range, as it were, and using the other tools that we have, the support and resistance indicators, looking at where the VPOC is, where these levels are, and we haven't talked about Camarilla. The Camarilla one has levels as well. It will help. It will, it'll give you something. It will give you like an objective where possibly there could be a reversal, but you would still have to look at it in terms of what is happening on the faster time frames. And in fact, in looking at it here, I'm not going to take the other lines out, but if you look at the New Zealand and the Aussie, there seems to be a little cross. So clearly on the 5 minute, there is some kind of divergence. And this is also another factor, another aspect of the CSI. Yes, we like to look at reversals. We like to see these strong moves higher, as we see here in the Canadian, strong move lower in the British pound. But it's a very, very subtle indicator. It can tell you an awful lot more than you realise, than just simply, overbought and oversold. And in a way, it's a shame we've had to use these expressions, because that's how most traders see. They say, if something's overbought, it's oversold. I understand that. But actually, price action is far more subtle, and the indicator reflects that as well. Is there anything else you want to add to that, darling? Is that okay? Let me just have a look back on just like looking on the, here we are. This is the daily on our favourite. Here we are, as it's often known, the dragon, because it can flame you alive if you're on the wrong side. What's interesting? Let's see what's happening with this candle today. Let's look at what the volume is going to come in under that, and in fact whether this pullback, and in fact we are going to get a resumption of the move higher. I think Simon said look at the weekly. We'll see what the weekly is saying. Well, it's got a nice strong up candle, but a very strong. Do you want just to jump in? Yeah, jump in.
Thanks, Simon. It really does highlight another issue of the whole business of multiple timeframes. And even if you're an intraday trader, then stepping down onto the dailies and the weeklies, it just gives you a perspective. And this is just a classic example. You can see just by eye the strength of potential resistance that's built in that region round about where Anna's cursor is there. What is it, 148, 148, I don't know, 20, 25, something like that. So that region there, that red dashed line, that's a very, very significant level of price resistance, which has acted so far over the last, what are you on weekly here? It's acted, it's held. There was a minor breach of it going back to back end of last year. Still couldn't get through, and that's back to the previous year. So as far as last year is concerned, it pretty much held. It's pretty much held this year so far. It's being tested again. If the market breaks through that region, then you have a massive, massive platform of support in place for any move to the upside. And either as an intraday trader or potentially a longer term trader, that's going to give you a strong, strong hint as to which direction this market is going to go. It's bounced off it again this week. But as I say, if you see a close above that, then that's a massive, it's such a significant level that on the chart. So thanks for highlighting that one. It really is significant. And again, it just highlights this whole business of using multiple timeframes. The volume down there is, well, it's kind of interesting because I'd say it's a little bit lightweight in terms of the week before last. It's very hard at the moment because of the politics that are overlaying it. And you've really only got to get one decision or one statement or whatever it is, and the whole thing is flipped on its head. So, but nevertheless, from a technical perspective, at any rate, that's certainly the level to watch out for in terms of the pound yen. Just pass back to Anna.
go down there. I think actually we're going to stop there because we've gone over as usual, far too long. Right. Finally, with the yen, obviously I've got a yen index. This is the one that we've developed for Ninja Trader. It's available also on MT4, MT5, and on TradingView as well. And on TradingView, we've actually developed a pound index, which we are going to get around to developing for the other platforms. And if you have a full package, if you've invested in the full package of indicators, that will be automatically added to your package. It's one of the benefits of investing in the full package. Whenever there's an upgrade or there is we develop new indicators, they are free issued to you as part of the of what you've paid, basically. Right, very quickly, is there anything else you want to say on that? Right, there's so much to say on the UK, on Brexit. Apparently some other votes have some other amendments. The way the Parliament works here, the politicians can put forward amendments that they then give to the Speaker. Our dear John Bercow, who suffers from short man syndrome, and he has a very powerful position in the Houses of Parliament, and basically everyone has to be nice to him because he's the one who can decide whether any amendments can be tabled, put forward, and then the politicians can spend, however many minutes and hours talking before there is a vote. And apparently he has a reputation. It was not just a reputation. He's a Remainer, and he has put his own oar into frustrating, if you like, as is perceived to be frustrating, what the result of the referendum was to goodness gracious 2 years ago. But the votes that the amendments that are tabled is basically, I think, a second referendum and what else is there? Or something else that's got everyone terribly excited. Just remember, it's enshrined in law the 29th of March. The only way that it can change, and anything can happen, is the law, the Act of Parliament, will have to be repealed. I'm not sure they will take. That would really be, the whole thing would blow up. But that's why you get all this hoo-ha every time these amendments come into. You read about them on the news feeds. They are just they're a mechanism in Parliament, and they're allowed to discuss. And then, of course, they've voted on, and it will be the result of those votes. Oh, that's right. He's also threatening that Theresa May will not be able to bring MV3 back to Parliament, which is the meaningful vote 3. So she's been defeated twice. So she's going to have best of 3. Is it tomorrow? And it's the Ides of March tomorrow. Those of you who don't know, beware the Ides of March and Julius Caesar and all that. So it's all great fun at the moment. But for traders, it's a fantastic trading scenario, scene, as it were, and scenario. Very, very quickly, before we go, the indicators that we've been talking about from quantumtrading.com. This is the website for the indicators. Here we are. You just click on them. You go down here, and there's the individual indicators that you just again click on, and it will bring up the videos and all the support pages, really explaining how you use them. Very finally, let me just bring up my thing again. All right, we talked about the currency dashboard. If you were to buy the indicators individually, they come to 770, but the whole bundle price is at 497. We didn't really talk about the other indicators in the bundle. We just focused on the CSI. We will do that next time. It really gives you all the information you need as a forex trader. Overbought, oversold, global sentiment and risk. But as I said, with the CSI, it's much more subtle than just simply overbought and oversold. Fantastic, signals, signals that it gives you, and potential setups. This is the quantumtrading.com site where you will find details on the indicators, and you can buy one, you can buy a bundle, currency dashboard, or complete package. And as I said, if you invest in the complete package, you receive all future indicators for free. It is all covered by a 7-day money-back guarantee, and you do get 24/7 support. And as I said, all upgrades are free. The education that we've referred to, here it is, the complete forex trading program, quantumtradingeducation.com. It does include the full package of indicators in the complete cost. And in fact, on this one, on the Ninja Trader tools, the full package is 1197. The education element is 497. So it makes it a price of 1694. So really, the education is less than $500, and it's really everything you need to know to do with trading this market. So you have psychology, fundamental, relational, technical, and what we call the mechanics of trading. A huge self-directed, you can take your time to absorb it all. There's PDFs there, there's over 7,000 slides that explains everything on volume price analysis, price action, and a lot more. And as I said, it does include the package. Total is 1694, but it does include all the indicators, and you can buy it on a 3-month plan, which is about 80% of all our students. That's what they do. They take it on a they pay for it over a 3-month basis. And finally, you can catch up with the analysis, everything that we've got to say about the markets at annacooling.com. Anything else you want to say, David? I think I covered everything on this time, which I remember. Thank you. I'm out. Brilliant. Okay. Thank you. Fantastic. Thank you so much for coming along today. It's been lovely to have you. I do apologise for all the technical hoo-ha with GoToWebinar. I'm really not having much luck with GoToWebinar at the moment. We are back later. Is it 3:15? We're looking at the indices and the commodities, particularly gold, silver, and oil, which are all very, very interesting at the moment. So enjoy the 3:15 our time. It's only 2:00, so it's another hour and a quarter. So hopefully you can join us then. If not, we're back next week, and we're back on Tuesday as well. So whatever you do, have a great trading day, stay safe, and we'll catch you next time.